Hi everyone, welcome back to my channel. Confused by mutual funds? Don't worry, you are not alone. For many first time investors in India, just hearing the words mutual fund sounds complicated, risky, and full of finance jargon. But here's the truth, mutual funds are actually one of the simplest and most powerful ways to grow your money. Think of it like this. Imagine you and a group of friends pooling money to buy a big pizza. Instead of buying separate slices from different places, you all pitch in and get a big balanced one made by a chef. That's your fund manager. That pizza, that's your mutual fund. A mix of different stocks, bonds, or assets managed by a professionals, so you do not have to stress. But is it really that easy? What kind of mutual funds are out there? How do you pick the right one for you? And most importantly, can you actually lose money? We are going to break down all of this step by step in this video in a way that's clear, real, and totally beginner friendly. If you have been thinking about investing but never know where to start, this is the video you have been waiting for. Alright, let's start with the basics. What exactly is a mutual fund? A mutual fund is simply a way for people to invest their money together in a variety of assets like stocks, bonds, or even gold. Think of it as a big basket. Each person's put in some money and all that money goes into this basket. A professional fund manager then takes this basket and decides where to invest the money based on research, analysis, and market trends. Let's say you want to invest in the stock market, but you do not know which company to pick or you do not have time to track the market daily. That's where mutual funds help. You invest your money into a fund and the fund manager does all the heavy lifting. They buy and sell shares, manage risk, and try to get the best returns for everyone who invested. You also get something called units of the fund, kind of like owning a small piece of the big investment basket. As the value of the investment in the funds goes up or down, the value of your units goes up or down too. Now here's something cool. Mutual funds are regulated by SEBI. SEBI stands for Securities and Exchange Board of India. It is India's regulatory body for the securities market. It oversees and regulates stock exchange, brokers, listed companies, and other market participants to ensure transparency, fairness, and the protection of investor interest. SEBI was established in 1988 and given statutory power in 1992, which means your investment is under strict rules. It's not a gambling. It's a system built with protection in mind. Also, mutual funds are super flexible. You can start with as little as 100 or 500 rupees per month, that less than a dinner outing. And you do not need to be an expert, you just need a goal like saving for phone, a car, or even retirement. So if you have been scared of investing because you thought it's only for rich people or finance nerds, mutual funds might just be your perfect starting point. Now that you understand what mutual funds are, let's talk about the different types of mutual fund you can invest in. The most common one is the equity mutual fund. This type mainly invests in stocks, meaning you are essentially buying a piece of companies. Equity funds are great if you are aiming for higher returns over the long term, but there is a catch. They come with higher risk too. The stock market can be unpredictable, so if you are young, have time, and can handle some ups and downs, equity funds might suit you well for goals like buying a house, starting a business, or building wealth over 5 to 10 years. Next up, debt mutual fund. This invest in fixed income instrument like government bonds, corporate bonds, or treasury bills. Think of them as safe land. The returns are steady and predictable, but generally lower than equity funds. These are perfect for short-term goals like saving for a trip, wedding, or emergency fund, or for people who prefer stability over big gains. Then we have hybrid mutual fund. This makes both part equity and part debt. For example, 60% in stocks and 40% in bonds. They are designed to balance risk and reward. If you want growth but do not want too much volatility, hybrid offer a nice middle ground. Now here's one for the chill investors. Index fund. This do not try to beat the market, they just mirror it. So if the Nifty 50 goes up, your investment goes up. And because there is no active management, the fees are super low. Index funds are simple, low cost, and a great passive way to invest long term. Finally, there are sectoral and thematic funds. This focus on specific industries like technology, pharma, or banking. They are high risk, high reward. If you understand a particular sector and believe in its future, this could be worth a shot, but only for advanced investors. Each of these fund types serves a different purpose. Your ideal choice depends on your financial goals, how much risk can you handle, and when you need the money. Let's talk about the real deal, the benefits and risk of investing in mutual fund. First, the benefits. The biggest one, diversification. Instead of putting all your money into just one stock or company, mutual funds spread it across many different investments. This helps reduce your risk. If one company does not perform well, others in the fund can balance things out. It's like ordering a thali. Even if you do not like one dish, the others still make the meal satisfying. Second, professional management. Not everyone has the time or knowledge to study the market, read chart and analyze companies. That's where the fund manager steps in. These are trained experts who research, plan and make investment decisions on your behalf. Third, low entry barrier. You do not need to be rich. Mutual funds are designed to be affordable through a SIP. SIP stands for Systematic Investment Plan. It's a method of investing in mutual funds where you invest a fixed amount regularly, example monthly, instead of a large lump sum. This disciplined approach helps you build wealth gradually over time, even with small investment. You can start investing with as little as 100 or 500 a month. Over time, even small amount grows big thanks to the power of compounding. Fourth, liquidity. Need to withdraw your money? In most mutual funds, it's easy. You can redeem your unit online and get the money in your bank account within a couple of days. No long lock-ins, no complication. Now let's talk risk. Because no investment is 100% safe. First, market risk. Mutual funds depend on the performance of the market. If the market falls, your investment value might drop too. That's just part of how investing works. Second, exit load. Some fund charges a small penalty if you take your money out too soon, usually within a year. It's meant to encourage long-term investing. Third, expense ratio. This is the fee charged by the fund house to manage your investment. While small, it can add up, especially in actively managed funds. Always check the expense ratio before you invest. And finally, performance risk. Not all funds deliver good results. Past performance is not a guarantee of future returns. You will need to review your investment at least once a year. Understanding both benefits and risk is the smart investor's way forward. When you know what to expect, you are in control. Alright, now let's get to the part everyone's waiting for. How to actually start investing in mutual fund. Before you start investing, secure your financial foundation. First, build an emergency fund to handle unexpected expenses. Second, get health insurance to protect against medical emergencies. Third, buy term insurance if your family depends on your income. Only after these three are in place should you think about investing. Let's move on to the step. Step 1 is setting your goal. Ask yourself, what am I investing for? Is it a short-term goal like buying a new phone? A mid-term goal like a car or a wedding? Or a long-term one like retirement? Your goal will decide what kind of mutual fund is right for you. Step 2. Understand your risk profile. Are you okay with ups and downs in your investment? Or do you prefer stable, low risk returns? If you can handle some volatility for higher growth, equity funds may be right for you. If you want safety, stick with debt fund. If you are somewhere in between, hybrid funds are a good middle path. Step 3. Choose how to invest. You have got two main options, SIP and lump sum. SIP or systematic investment plan means you invest a fixed amount every month. It's great for beginners, especially if you do not have a big amount to invest all at once. Plus, SIP helps you average out the ups and downs in the market. Lump sum, on the other hand, is when you invest a large amount in one go, better suited for those with a higher risk appetite and some experience. Step 4. Get your KYC done. This is mandatory. KYC stands for Know Your Customer, and you will need to verify your PAN, Aadhaar, and a few basic details. The good news, you can do this online now, no paperwork, no visit to the bank. Step 5. Choose your investment platform. You can invest directly through the fund house websites or through platforms like Coin or even your bank. These apps are user friendly and let you track your investment anytime. Step 6. Start small. Don't feel pressure to go big on day 1. Even 500 per month through SEBI is a great start. Once you get more comfortable, you can increase it. And lastly, stay consistent. The key to building wealth with mutual funds is not timing the market, it's time in the market. The longer you stay invested, the more your money can grow thanks to compounding. Remember, starting is more important than being perfect. You will learn as you go, and trust me, your future self will thank you for taking this first step. Now that you know how to start investing, let's talk about what not to do. These common mistakes can quietly hurt your returns, so avoid them early on. Mistake number 1. Chasing high returns. Don't pick a mutual fund just because it performed well last year. That does not mean it will do great next year. Always match the fund to your goal and risk tolerance. Mistake number 2. Ignoring risk. Some people blindly choose equity fund because they hear stories of huge returns, but if you panic and withdraw during a market dip, you will lose money. Know what you are getting into. Mistake number 3. Stopping SIPs during a market crash. Ironically, when the market is down, that's when SIPs work the best because you get more units for the same money. Stay consistent. Mistake number 4. Not diversifying. Don't put all your money in one mutual fund, spread it across a few. Equity, debt, maybe a hybrid. This cushions the blow if one fund does not perform well. And lastly, not reviewing your portfolio. Things change, goals, markets, fund. Check in at least once a year to make sure your investment still fit your plan. Let's wrap this up with a few final tips. Start simple, don't get overwhelmed by all the options out there. Pick one or two beginner friendly funds and get going. You can always refine your choice later. Be patient. Mutual funds are not a get rich quick scheme. They work best over time, so let compounding do its magic. And most importantly, stay consistent. Whether it's 500 or 5000, what matters is that you keep investing. If this video helped you understand mutual funds better, don't forget to like, comment your questions, and subscribe for more simple finance content. We are here to make investing easy for everyone. Thanks for watching and see you again.